Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look at a number of different things. We do look at other markets outside of the S&P to try to get some clues as to what's happening with the S&P 500. I do a pretty extensive sector analysis within the S&P and also look at the valuation of the S&P, not only on a historical basis, but then looking forward. And then we look at other markets because sometimes we can get some clues as to what's happening in other markets with what may be happening in the S&P 500 itself. This is being prepared for Monday, July 1st. Before I get started, I do have a thing called the SPXInvesting Program. It launched at the beginning of June. It's much more involved than just the videos that I do here. If you want to learn more about the program, there are some videos on YouTube. I have a playlist there. There are also videos on Rumble. Below this video is a link to actually get to the website for the SPXInvesting Program. There's also a link to find more videos that talk about the program that is being offered. First of all, I look at S&P 500 valuation. We look historically. This is called the trailing 12 months. This looks backward at earnings reports and compares it to the current price of the S&P to see if we're inexpensive, fairly valued, or cheap, or overvalued at any particular time. The black line is the S&P 500, and the dashed red line, that's the PE ratio of 20. When we're above this line, that means the market on a historical basis is considered to be expensive. I also blew that up down below, and we've been this way for a number of years now. And it's not really surprising to see this. We don't use this to make decisions. We just want to know what's the current state of the market looking back on a historical basis. Here's another chart of that same thing, just showing different events that have happened going back to 1980. Another way of looking at historical earnings is a thing called the Shiller PE ratio, which takes more of a smooth approach. You also may hear this referred to as CAPE, C-A-P-E, developed by Robert Shiller. The current reading that we're getting is 35.56. To give that some perspective, the median and the mean is a little bit under 16 and a little bit over 17 currently. So we're double even more than double what the historical valuation should be. Again, we've been this way now for a number of years, and we can stay in this condition for a long time. But the market doesn't do that. It looks forward and looks at what they think the PE ratios will be going forward from here based on analyst projections and forecasts. And this chart's a little bit different as we have the mega cap 8, known as the great 8, or the big stocks that are really driving the market. That's the purple area right now. We are quite expensive. We're above 30, even looking forward. But the market seems to be okay with that, at least right now. You can see that this purple line here, it can get pretty high even as the market's going higher. These are the big tech and growth companies, which is what everybody's talking about these days. And so to see them trading even on a forward-looking basis as being expensive is not necessarily a surprise. We also look forward with the red line. That's the S&P 500, where we're coming in a little bit above 20 at 20.9. And down a little bit are the mid caps. They're coming in at 15.1. They're just about at that fair value level, and a little bit under the 15 level at 14.1 are the small caps. So we keep an eye on this. Again, we don't necessarily use this to make decisions. We just want to know what the market's looking at as far as earnings, not only historically, but moving forward. Then I look at growth versus value. The first one here is an index of peer growth. And you can see, looking at it by itself, it is in an uptrend and doing pretty well these days. We also look at a peer value index all by itself. This one is not as strong, and that's what we see in a more solid environment. We see growth tending to outperform value. It's below its 50-day moving average, but still in an overall uptrend. Now is where it gets kind of interesting when I do ratios between the two. We have a growth to value ratio on top showing how growth is outperforming. Then I do an inverse of that on the bottom, showing how value is underperforming growth. I also look at a couple of growth to value ETFs, showing how growth is outperforming here. This is an inverse showing how value is underperforming. I look at those same indexes that we saw earlier and then do a ratio with a longer term chart. This is also showing how growth continues to outperform. Here's an inverse with a shorter term look showing how value is underperforming growth. Then I look at some other indexes here where we also see that growth is outperforming value. And then a couple of different ETFs showing that the growth to value ratio here is seeing that growth is outperforming value. So we're hanging in there. Not a lot of strength right now, but growth is outperforming value and has been for most of 2024. Here's an inverse showing how value is underperforming growth. And I break it down a little bit. Here are the small caps, and they've been really frustrating in 2024. We continue to chop sideways with the growth to value ratio. The mid caps, which had been stronger earlier in the year, they're just chopping sideways now with their growth to value ratio. We're seeing a little bit better reading here with the growth to value ratio for the S&P, and this is the one that I focus on the most. We fell back on Friday with a down day, but we have been breaking out above these previous levels and looking more solid. We just need to see more follow through with this. We keep an eye on inflation. On top is a monthly chart of the CRB, that's commodities. And then on the bottom is a ratio between the inflationary areas and deflationary areas. And we continue to be below a declining moving average, which means that according to this, inflation is not necessarily a problem on this monthly chart. So we get a bigger picture look. Then I look at a daily chart of the CRB index where it is in an uptrend, but recently it fell below its 50-day moving average. The Baltic Dry Index, another inflation gauge that we look at, it's chopping around an awful lot lately. When this really goes up, that tends to be more inflationary. When this goes down, that's more deflationary. Some other markets, really, I only look at them about once a week, but we want to keep an eye on some of these commodities markets. Aluminum is in an uptrend right now, and corn is in a downtrend. It came up to its 200-day moving average and has been dropping back down. Wheat also really started to go higher, but lately has been dropping back down as well. When these go down, that tends to be more deflationary. Here's a look at fertilizer, where it's climbing in the most recent reading, but we've been relatively flat with the price of fertilizer. Oil is getting back up above the 80 level right now. We had got down into the 70s, so this is starting to go back up currently. We keep an eye on gas. It's in an uptrend, but it has been falling back as we approach the summer traveling season. And I used to show a different chart of diesel. This is from Yardeni's website, Edward Yardeni, where diesel has been coming down. We keep an eye on this because this is for railroads and 18-wheelers, and this going lower just means that shipping costs are not necessarily increasing. Heating oil, not really needed all that much in the summer, and it's been in a downtrend. Natural gas really started to go lower, but since has been bouncing back up, but it's still in a longer-term downtrend. Copper, which is a barometer of the U.S. economy, when this is going up, the market is anticipating that things look better economically. It did look like we were just having a regular pullback, but now we're starting to break below these moving averages. We're still in an uptrend here, but this has been showing some weakness lately. And then we look at a ratio between copper to gold. As this is going down, that means copper's underperforming gold, and gold hasn't been doing all that much lately either. Here's a longer term look at this chart. The black line is the copper to gold ratio. And then I also plot the 10-year and the 2-year in green and red, just to see if we can get any insight from this. But there's quite a wide spread between these, even though they're on different scales. Here's where gold has just been chopping sideways lately, actually dropping below its 50-day moving average. Silver, also right about at its 50-day moving average, after seeing a really nice run up, has lately been pulling back. Then I look at the closing price for gold on top, closing price for silver in the middle, and take a correlation measure down below. And that just means that they're tending to go in the same direction at the same time, which makes logical sense. But here we can show it actually by looking at a chart. Then I do a gold to silver ratio on top. When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And then we plot the US dollar index in the middle. And we can see they're kind of neutral right now, the top chart and the middle chart. Sometimes when there's a real high degree of correlation, this can help us give us more insight into the US dollar. A rising US dollar is negative for stocks because of conversion rates and import-export relationships there. The stock market likes a weaker dollar, but it's actually been holding up fairly well lately. Here is the dollar all by itself, showing on the daily chart where it's in an uptrend and getting back up into the mid 105 range. Here's a 3-year chart showing how we finally broke out above this trend line, but since then we went up and we've been chopping more or less sideways. And here's the euro up on top, and then the US dollar index. And these are pretty much a mirror image of each other. Even though the US dollar index has other currencies that are calculated in it, the euro by far is the biggest currency. And then we look at the Japanese yen, which is in a really solid downtrend compared to the dollar. And then I have some breakout charts where the euro is in a downtrend compared to the dollar. We're falling below the moving averages here as it's been chopping more or less sideways. The Japanese yen is really in a downtrend compared to the dollar. British pound is in an uptrend compared to the dollar. It had been breaking out and falling back down to its 50-day moving average. Then we look at some different indexes. I do show this in the daily video. The red line is the equal weight S&P 500, where the bar chart here is the regular S&P 500, which is a weighted index. Just to give us an idea, when we see the S&P going up or even sideways now and the equal weight going down, that's a negative divergence. We want to see more broad market participation. When this shows that the S&P is outperforming, that means the really big stocks are really leading things higher. Then here's kind of that same thing, only reversed, where we look at the equal weight to S&P 500 ratio, and this is tending to go down. That means the big stocks are still leading the market. Here's a ratio between stocks and commodities, showing how stocks are outperforming, even though when you look at them independently, they're both in uptrends. Here's an inverse showing how commodities are underperforming stocks. And we look at the NASDAQ 100 and compare it with the S&P 500. They're both really doing well, coming off of recent all-time highs, but the NASDAQ 100 is even performing better. And the S&P 100 continues to outperform the S&P 500. The NASDAQ to S&P 500 ratio shows the NASDAQ is outperforming. And this is kind of interesting. The NASDAQ 100 has been the real leader of the market as we've been coming up out of the lows since October 2022. But when we look at a ratio between the NASDAQ 100 and the NASDAQ, it's actually underperforming. And we've seen a recent death cross with this ratio. Now, the NASDAQ 100, the NASDAQ, they're all doing fine independently. But this is actually showing where the NASDAQ is now outperforming the NASDAQ 100. We look at the mega caps, growth stocks. These are the really big companies and compare it with the equal weight. And not surprisingly, it's showing how the mega caps are outperforming. Then we do a ratio. The red line here is the small caps to S&P 500. These just continue to decline. The small caps continue to underperform the S&P. This is another measure showing how small caps are in a downtrend with this ratio compared to the S&P. We look at the biggest software companies, which really been kind of a disappointment in 2024. We're not seeing much of an upthrust here. We are getting in danger of seeing a death cross here with the trend, but lately over the last few trading sessions, this has been bouncing back up and may be starting to improve. Here's the mega caps all by themselves. This is the strongest area of the market and continues to be in a solid uptrend. The robotics and AI ETF, that's everybody's talking about AI right now. When you look at this by itself, it's kind of near the higher end of the rainbow, but as much is around this phenomenon or mania or theme or fad or whatever you want to call it in the market these days, you would think this would be doing a lot better than it is. And NVIDIA is included in this ETF. But where it's a little disappointing is when we compare it to the tech sector. The AI ETF is really underperforming and has been for quite a while. Then we look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities together. And it is in an uptrend when you put all of these three into one. We look at the S&P 500 and compare it with the price of 1 to 3 year bonds, showing how stocks are outperforming short-term bonds. Here's the S&P 1500, a broad market measure, also outperforming 1 to 3 year bonds. Then we look a little further out with bonds, another broad market measure showing how stocks are outperforming. And here's the total U.S. stock ETF, just coming off of setting a recent all-time high. Here's the low volatility ETF. This is what folks get into when the market's turning more defensive. Looking at this by itself, it's in an uptrend and above its 50-day moving average. Where it's interesting is to show how it's the low volatility ETF is really underperforming the S&P 500, especially going back to the early part of 2023. We look at the tech sector and compare it with bonds, showing how the tech sector is outperforming. And then we look at some other areas. I do show this in the daily video. I have an advanced decline line studies here. This is a little bit concerning and showing us some negative divergences. The NYSE common stock, although it is bouncing back up, it's still below its moving average. Holding up a little bit better is the S&P 500, barely above its moving average. Seeing some improvements with the mid caps and the small caps, but they're still below their moving averages. Here is traditional Dow theory, where the Dow set an all-time high not too long ago. It's been chopping more or less sideways and not really doing all that well as far as performance. The transports have been just chopping sideways. They have been doing better lately. And utilities, which were really going up into April and into May, have now been starting to fall back. We look at the transports by themselves. They're doing better lately, but they can't even get back to previous highs yet. Then we look at a ratio showing how the transports, last few days, they've been doing a little bit better, but overall, they continue to really underperform the S&P. Here's another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And we look at a relationship between the S&P 500 and the transports, and they were actually going in opposite directions there for a while. Not a real strong correlated relationship, as the S&P to this point has been holding up better as the transports have been underperforming. And we look at a new idea behind Dow theory. Instead of using the Dow, we use the S&P. Instead of using the transports, we use the NASDAQ. And these are not really showing any negative divergences right now. They're doing fairly strong. Then this is broken down a little bit further. Instead of looking at the S&P, we look at the S&P equal weight. Instead of looking at the NASDAQ, we look at the NASDAQ 100 equal weight, where we're coming back to previous highs here with the QQQ equal weight ETF, but we have not set new all-time highs here with the equal weight S&P 500. That's a bit of a negative divergence and a little bit of a concern. And so we'll keep an eye on this. This just means that the bigger stocks continue to really outperform. The FANG index, coming off of setting an all-time intraday high, but closed at the low on Friday, still in a solid uptrend when you look at this all together. I have this on here in case we see some weakness. I'll be trying to pick out some areas of support if we fall. The Wilshire, another broad market index, set an intraday all-time high, but then closed near the low on Friday, but still in an uptrend. ARC, which has been a real disappointment, we're seeing it on the weekly chart where it's now crossing over and giving us a death cross there. It's also here on the daily chart giving us a recent death cross. This just hasn't been performing well. And ARC has a really huge position in Tesla. And since that's been really underperforming, that's had a huge impact on ARC. Then we look at the all-world ETF, which excludes U.S. stocks. And altogether, they are doing well and just a little bit above their 50-day moving average. Then we look at this on a ratio basis. This just shows that U.S. stocks are outperforming world stocks. Here's a monthly chart looking at the S&P 500 and those stocks that are in Europe, Australia, Asia, and the Far East. We're above the red line, and we've been there for a long time now, going back to 2010, 2011. And so this just shows that U.S. stocks are outperforming on this longer-term chart. And the momentum is measured down on the bottom, and that is starting to go back up, showing how U.S. stocks are also outperforming. We look at bonds based on price. This is the total bond ETF, which is above its 50-day moving average and still in an uptrend. The Pring World Bond Index is in a downtrend. It's really been choppy lately. U.S. bonds are holding up okay, but world bonds are under more pressure. We look at a monthly chart of stocks to bonds, showing how stocks continue to outperform. And this also is a daily chart showing how bonds are underperforming stocks. We look at high yield corporate bonds, also known as junk bonds, just coming off of setting recent all-time highs. And we look at more conservative bonds, which are still in an uptrend, but not performing as well, as folks are tending to favor the junk bonds over more conservative bonds. This is a ratio between the riskier bonds and conservative bonds. We are seeing this trailing off a little bit. There's speculation in the market that maybe interest rates will be cut in September. And if that's true, if we're going to see a little bit more economic weakness, folks will be getting out of the riskier junk bonds, which give you a higher yield, even though it's more risk, and getting into more conservative bonds if they can lock in a higher rate for a longer period of time. And when that happens, we tend to see this ratio coming down. But we've seen this before, only to have it turn and go back up. We look at a correlation between stocks and bonds. They're pretty much neutral right now. They're not really moving together or in opposite directions. Here's the Dow Jones Corporate Bond Index, which is in an uptrend, but for most of 2024 has pretty much been just going sideways. This is a fib study on the 10-year yield. We're in between these retracement levels, so there's really not much to see here. This is a longer-term chart of the 10-year Treasury yield, where it does look like we're shifting to a higher interest rate environment, which is different than what we were seeing for about a 40-year period of time. Here's another fib retracement study with the 30-year yield, and we're right in between, so there's not much to see here. This is stocks versus the 10-year yield, showing how stocks are outperforming, even though we've seen some recent weakness. And this is looking at bonds compared to stocks. When this is going down, that means stocks are outperforming or bonds are underperforming. And this is more healthy for the market with this ratio declining. Junk bonds, which are coming off of setting recent all-time highs. And then we do a ratio between junk bonds, riskier bonds, and more conservative bonds. And we're also seeing a bit of a pullback. We came down to the 200-day moving average here with this ratio. We'll have to see if this continues to fall as folks may be shifting from the riskier bonds over to more conservative bonds. But again, we've seen these kinds of things before, only to have it switch back and see this ratio continue to go back up. We look at an ETF of the 7 to 10-year bond based on price. We've been chopping around, showing a little bit of improvement, but then we really took a nosedive in Friday's session. Here is a daily chart of the yields where we had been coming down, but lately we saw a little bit of a spike up, especially on Friday. Here's a weekly chart looking internationally with the US, UK, and German rates all advancing, and even the Japanese rates advanced a bit. Then I look at volatility, and what we use to measure volatility in bonds is called the MOVE index. What we use to measure volatility in stocks is called the VIX, and we see that there's really not a correlation between the two. They're having a tendency to go in opposite directions right now. And we're just finishing up the end of the second quarter, the first half of the year, entering the third quarter of 2024. There's some shifting going on right now in the market. The market's really been chopping more or less sideways. A lot of folks are predicting a real decline from here, which may happen. That's still a normal thing to happen, even in an uptrend. But while this is taking place, the volatility is really kind of going in opposite directions right now. Here's a monthly chart of the price of the 30-year bond, where it has been in a downtrend. It's coming back up to the moving average here, but the moving average is still declining. But when we compare the long-term bond with the commodities, bonds continue to outperform. But this can take a long time to shift because this is a monthly chart. Then we look at different sectors. And the first thing that I do is I just look at the sector all by itself. I arrange these in alphabetical order by symbol, so there's really no favoritism given here. This is the materials sector by itself, where it's dropping below its 50-day moving average, even though it's in an uptrend. Then down on bottom, we have two different measures here. The relative strength ratio, which is the red line, and that's been coming down and starting to flatten out. And then we look at the relative strength momentum with the S&P 500, or here it's with the SPY. This is showing a little bit of an improvement here, but nothing really all that strong. Then here is where we do a ratio between the materials sector and the S&P 500, showing how it's really underperforming. We look at communication, one of the stronger areas of the market, showing a little bit of strength, both with the momentum and the relative strength ratio here, but still under 100. When you look at this all by itself, this is a stronger area, even though it was down 0.91% on Friday. Then we compare this with the S&P 500, where it really hasn't been outperforming all that much. It's still in an uptrend with this ratio, but it hasn't been breaking out lately. Looking at energy, showing some strength with momentum and relative strength with the ratio. We did come down to the 200-day moving average, and we're bouncing up off of that. But so far, we've not been able to clear the 50-day moving average with this sector. And it continues to underperform, even though it's been bouncing back lately when we compare it to the S&P. The financials, one of the stronger areas right now, and that tends to be more positive for the market, still hanging around its 50-day moving average, seeing an improvement with momentum as far as the relative strength ratio after it had been declining. And we do a ratio here where the financials, even though they're doing well, have been underperforming the S&P. We look at industrials, which are also just a little bit under their 50-day moving average, but still in an uptrend, showing a little bit of an improvement here with momentum and coming back up after really falling with the relative strength ratio. But when we compare it to the S&P, we're seeing a death cross here with this ratio as the industrials are really underperforming. Tech sector, this is the strongest area, and this is what everybody's talking about. Looking solid and in a really good uptrend coming off of a recent all-time high when we look at it by itself. Seeing a little bit of weakness here with the relative strength ratio and the momentum as we've been pulling back lately. But this is the area that's really been keeping the market together. So if we see more weakness in this area, that could really drag things down for the indexes. And we're still looking good here when we do a ratio between tech and the S&P 500, even though it has been pulling back as of late. The staples sector, this is an area that we're keeping an eye on because this is more defensive. And when folks get into this, just think of toilet paper and toothpaste, things that you have to have no matter what's going on in the economy. Seeing a little bit of improvement lately with momentum and relative strength and still above its 50-day moving average when you look at it by itself. But when we compare it to the S&P, it is underperforming. And real estate, which has been pretty much the weakest sector in 2024, it's above its 50-day moving average, but just can't seem to get any strength right now. It's showing some improvement with the momentum and relative strength ratio, but not showing an awful lot of breakout potential, at least yet. And it's really underperforming when we compare it to the S&P. Utilities, this is another strong area. You could say that utilities have been doing well because of AI and all the mining and everything with Bitcoin and cryptos that needs to take place. Or you could also say, this is more defensive. The market tends to get into this area when they're worried about a decline in the stock market. We had been really coming up, and now we're falling back down to the 50-day moving average. We're seeing the red line going down. That's a relative strength ratio, but we're seeing the momentum actually showing some improvement. And they're still underperforming when we compare utilities to the S&P, even though we've seen a recent golden cross here with this ratio. It was really going up, but since then has been starting to underperform again. We look at another ratio between the S&P and utilities. When this is going up, that tends to favor the S&P since it means it's outperforming utilities. We look at healthcare, another defensive area, not really breaking out at this point, but still looking okay when you look at it by itself. The momentum and relative strength are showing some improvement after dropping below 100, but it continues to underperform the S&P. Discretionary, the thing that makes life fun. This is in an uptrend, but not really breaking out above these previous levels yet. The momentum is showing a little bit of an improvement, and the relative strength ratio is also looking better. This is the area. This has Tesla and Amazon in this, and this is one of the more kind of growth areas that we want to see doing better. We want to see tech, communication, and discretionary outperforming the market. That really helps to drive prices higher. And then it would help if the transports could also start to show a better performance. So this is why we keep an eye on this particular area. But when we look at it compared to the S&P, discretionary continues to underperform. Semiconductors, one of the strongest areas within the tech sector, coming back, setting an all-time high, seeing some profit taken lately, but still in a solid uptrend. So that's turning the relative strength ratio and the momentum down. And we compare the energy sector with the tech sector, and this is just showing how the energy sector continues to underperform tech. We look at growth stocks and compare them with bonds, showing how growth stocks are still outperforming. We look at the tech sector and compare it with the 10-year yield, showing how the tech sector is outperforming. Here's an inverse showing how the 10-year yield is underperforming the tech sector. We do another ratio between discretionary and staples. It is improving, but we came right up to the 200-day moving average with this ratio, and we're bouncing back down. We want to see discretionary outperforming to be more positive on the market. And here's another look showing how staples are doing better than discretionary, but came down to the 200-day moving average with this ratio as well. Gold to the S&P, I know there's a lot of people that are just all fantastic about gold, but when you compare it to the S&P, yeah, we're seeing a recent golden cross here with this ratio, but it's really been pulling back lately. And if you look at this longer term, gold is not necessarily outperforming the S&P. But when we look at gold versus the dollar, it did break out, but now as gold has been under some pressure and the dollar's been holding up, we're seeing this ratio coming back down. High leverage loans, and I always talk about this. If the market was getting ready to fall off a cliff and the economy was getting ready to fall off a cliff, this wouldn't be setting new all-time highs. So this gives us some confidence about things right now. We are really in a solid uptrend, well above the 50-day moving average, barely coming down and actually touching it even when it pulls back. We have been seeing a little bit of weakness with the momentum and relative strength here, but this is starting to turn back up. The NYSE composite, a broad market measure that I like to keep an eye on, coming back up to its 50-day moving average, also in an uptrend. All stocks, also US and international stocks, continue to be in an uptrend. Emerging markets showing a little bit of improvement here, but not really breaking out, but still in an uptrend. And the Japanese Nikkei index coming back up to the levels that were set back in 1989, trying to set a new all-time high. The small micro cap stocks are still in an uptrend, but really have been chopping sideways, as has been the small caps. Then we look at the S&P on top and the home builders ETF in the middle, and then do a ratio between the two. I'm looking for negative divergences here, and we're not seeing that. They're actually having a tendency to go in the same direction. Bitcoin, which went up above the 70,000 level, has since been pulling back, came down close to its 200-day moving average, and so far has been able to hang out above that. Here's a longer-term look at international stocks where China is still in a downtrend. This is measured by the KST, so this is a little different momentum oscillator. Emerging markets are starting to flatten out after declining. We're seeing a decline in European stocks as there's some political unrest in France. And then Japanese stocks are in a downtrend, and we are still in an uptrend here in the US, but this appears to be rolling over slightly. Then we look at an intermarket analysis chart, which is the name of this video, and we compare different markets with each other. Oil still is doing about the best, going back to the beginning of 2024, followed by stocks, gold, and the dollar. Bonds based on price continue to be negative year to date. Now we look at some correlations, the S&P to the dollar, and they're having a pretty strong tendency right now anyway to go in the same direction, which is strange. Usually the stock market likes a weaker dollar, and so we would see this going in opposite directions, but right now they're tending to go in the same direction. We look at S&P to oil. They had a really strong correlated relationship. We're seeing oil rising. We don't know if that's because the companies that produce oil are doing better or because there's an increase in tensions between Hezbollah and Israel in the Middle East. That could be pushing up oil prices. And if stocks continue to languish and oil keeps going up, we're going to continue to see this correlation going down. We also look at stocks versus the 10-year yield, pretty much neutral right now. And then the tech sector to the 10-year yield also continues to be neutral. And then the S&P to the 2-year yield, where it's coming back down into the neutral area. Then some long-term studies. We have a monthly chart of the NYSE on top. We're above the moving average and still looking solid. So this is longer term positive for the broad market. We use the Copic curve here, which is a momentum oscillator showing that we still continue to be in an uptrend longer term. Then this is a daily chart of the NYSE with the record high percent index. This is continuing to go up. We saw a little bit of weakness the latter part of last week. So that's why this is coming down slightly. And then we look at a monthly chart of the S&P on top, which is doing quite well. And we use the percentage price oscillator showing that we're also in an uptrend here. And then we look at another shot of the S&P on top, and then we look at stocks versus commodities, showing how stocks are outperforming. And this is a daily chart. Then we look at one more global index. We look at the S&P 500 and the Dow Jones Global Index, a monthly chart, showing how on a longer term basis, US stocks are outperforming. The KST, another momentum oscillator, this is pretty much flat right now. But again, this is a monthly chart, so it can take a while to change. Then at the very end, I have a list of those things that are positive. My definition of positive as it applies to this video is when the 50-day simple moving average is above the 200-day simple moving average. We have the growth and value independently. Copper is still in an uptrend. The British pound compared to the dollar, gold, and silver are in uptrends. The dollar index, the CRB index, the big software companies, they're getting kind of close, but they're seeing a little bit of an improvement lately. The mega caps, that's really what's driving the market. The FANG index, the low volatility ETF by itself, staples, and the Dow Jones Composite Average, and all of the bonds that we look at based on price except world bonds. Those are in a downtrend. The tech sector and semiconductors, the high leverage loans, the Dow, the NYSE Composite, and Wilshire, those are two of the broad market measures that I look at. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, even though they've been all underperforming lately, they're still in uptrends. All stocks, emerging markets, and then Bitcoin, even though it's been pulling back, is still in an uptrend for the current time. Then I look at the negative things, and it's a relatively short list. This is when the 50-day moving average is below the 200-day simple moving average. The Japanese yen is in a downtrend compared to the US dollar. The euro, it's not really strongly in a downtrend, but still has been underperforming for a while. ARK is in a downtrend, and then the Pring World Bond Index. And those are the negative things that are happening. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.